Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, does the market volatility scare you? Are you afraid of investing in mutual funds because of the sharp ups and downs of the market? Have you had a bad experience investing in mutual funds and thus now prefer staying away from them? Well, if any of that holds true for you, then you must watch today's episode. For today, we'll give you steps to follow for a profitable mutual fund investment. Stay tuned.
You need to start right and you need to ask the right questions. But normally the starting point of our question is that tell me a good fund which will give the highest possible return in the shortest possible time with the least possible risk. And these things don't combine. In the short run, there is a possibility that it might look less risky, very rewarding and great return, but it will not sustain, it will not continue for a long time. So the starting point should be that for how long can you invest the money? What kind of downside can you withstand in between, assuming that you can invest for the next 10 years. But in between the money goes down, all the money that you have invested, that goes down by 40%, will you be able to withstand? Will you be looking at your investment every day? And then comes, and this is also a function of us gaining maturity over time. If you're a new investor, don't trust yourself, don't trust me. You have to understand that, investors, when they see a big decline in a brief period of time, they will get nervous. Rightly so, and I don't think it is avoidable. You should get nervous and you will be nervous and you will react, and that react will be to your disadvantage. So the way to begin is, the way to start is, the right starting point should be how long can you invest, how much can you withstand, and that is a function of how important that money is and how experienced you are. If you have been investing for 4-5 years, I'm sure you can withstand a 30-40% decline. And you will not get nervous because you have seen it. You have seen that, mutual funds or stocks or the markets in general or the index goes down and then comes back as well. But if you are witnessing it for the first time, you will run for cover. So that's the way to go. Ask these very meaningful, important. The most important question is the period of your investment. How much can you withstand? And if you are investing for a goal, how negotiable is that? If you are investing for 5-year time period, you are investing for a goal, and that goal is not negotiable. If it is for your child's education and he is going to get admitted in a school, that day cannot be negotiated. You need that money at that particular time. At most, it could be little variable by a month or so here and there. So depending on the negotiability, depending on the time frame, these are the questions to ask. So that should be your starting point. The starting point should not be highest possible return with least possible risk. That is not an investment. That is asking for moon. You keep hearing that you have to allocate your assets right. You have to invest correctly. And how do you do it? Because most of the time when we start investing, we begin our investment journey when the going is good. It looks like an opportunity loss or you are missing out on something if you are not fully invested. Many a times investors are so tempted to invest, they want to borrow money and invest. So that is when you start in a good time. And then the bad time follows because markets are cyclical. So then we run for cover. We try to take all our money out and make sure that nothing is invested in equity, and that is just the wrong way to begin. That is just the wrong way to start. And so your starting point should be, for most investors who are investing for the first time, they should not be entirely into equity. Always start with something like an aggressive hybrid fund. I'm giving you a very complicated name, but these aggressive hybrid funds are 75% equity, 25% debt. And the moment you invest, if the market goes down, this market will not go down as dramatically as the equity market because the 25% fixed income, the debt component, will provide it the cushion, the shock absorber. So that will be little comforting for you. So this is what I mean by asset allocation, that the kind of allocation which will help you navigate the turbulent journey of investment much better, or with rather stability. Once you get used to it, once you have the experience of 2-3 years, you have seen the ups and downs, and then you understand that okay, your money is likely to remain invested for another 15 years, and these ups and downs are actually an opportunity. They are not a damage. They will not hurt you in a permanent way. So decide on this asset allocation, and I think to begin with, don't decide because nobody will tell you. Start conservatively, and then the next starting point is, as you get closer to your goal, when you are likely to need your money, reduce your asset allocation, reduce your allocation to equity gradually. So maybe you should start with a 25% fixed income, 75% equity when you are starting. After 2-3 years, you can be substantially into equity if you are not getting nervous. And for 8-10 years before your 5-7 years before your retirement, or before you need the money, you can be reasonably like that. But 5 years before that, start putting money into fixed income gradually. That is the way you will be able to de-risk yourself from the market, because market is an extremely rewarding place, and market is a very dangerous place if you wait for the last moment, because when you need the money, the market can tank, and market can collapse in 5 days time, and it could be hugely disappointing. So be methodical about your investment, and be having the right asset allocation to be in line with your investment time frame, primarily investment time frame and your experience. Because once you have to begin with, you have no experience, nobody can tolerate the turbulence of equity. So that is why one should always start with little conservatism. So follow these rules, and following these rules will help you stay on track. I'm giving you a very difficult suggestion and a very easy suggestion. Let me explain. The way to be methodical with your investment is to choose the right kind of fund. And choosing the right kind of fund is not an easy thing, because there are 32 kind of mutual funds mandated by regulators. The regulator has said that there could be 32 kind of funds. And within these 32 kind of funds, there could be 50 others, because index fund is one category, and there could be 50 kind of index funds possible. So when I mean the right kind of fund, I mean for the asset allocation, you can have the appropriate kind of fund. And so as I said that, if you are starting, start with an aggressive hybrid fund. If you are likely to need the money and you are 3-4 years away from that goal, and you need all the money before that, maybe move your money to an aggressive hybrid fund after being in all equity portfolio for a long time. So choose the right kind of fund and keep it simple. That's the simplest way of being methodical about your investment. In the market, when investing in equity, we are normally in an extreme state of greed, or we are very fearful. And the way we deal with it is, if we have money and the market is going up, we confidently invest money, assuming that nothing will happen, or you are missing the opportunity. And the opposite is just as true. If the market has come down by 20, 30, 40%, we are looking for an opportunity to run away from the market. And the problem is that investing in a market frenzy is just as dangerous as taking your money out when the market has collapsed. And to tide over this problem, the simplest way is to be regular with your investment. And that is why everybody says, and why you should follow, that do your SIP. And the other side of not doing your SIP is that you'll be waiting for an opportunity for the market to go down to invest. And many a times you don't get that opportunity. And when you get that opportunity, you think that it will go down further. And when you go down further before the market comes back. So market surprises you all the time, and it will keep surprising you. So how to deal with this? The way to deal with this is Be methodical with your investment. Don't let your accumulation happen to a point where you have to make a big investment. But assuming that you have to invest 10 lakh rupees, and that is a large sum of money, and that large sum of money, if you invest at one go, the problem is that you invest and after that the market goes down, you will be full of regret, you'll keep cursing, and the decline will actually unnerve you. If that 10 lakh rupees somehow becomes 5 lakh rupees, which cannot be ruled out, that is the time when you actually get very nervous. You get so scared that when it becomes 5 lakh rupees and you invested 10 lakh rupee and you invested 10 lakh rupee just 4 months back, you will be willing to take the losses and not come back to the market again forever. And that will be a huge opportunity loss. That will also translate into a real loss the moment you take your money out. The way to deal with it is become methodical with your investment for 80% of your money, which means that if you have 10 lakh rupees, 8 lakh rupees you will spread and invest by way of SIP over the next 12 to 18 months, so which is 1 to 1.5 years. And if at all you want to try out, trying to time the market, do it with 20% of your money. So you will satisfy your urge to time. At the same time, you are unlikely to miss a huge opportunity, assuming that the market does not correct and it keeps going up. Your money will get invested. It will get invested without much of an opportunity loss. And with your 20%, try your luck. Resist all your wrong reasons to sell. Money goes up. The most frequently asked question at Value Research is when market has gone up, and many investors often ask us that the money has gone up and they should pull their money out, and they do take their money out simply because the market has gone up, your investment has done well, so investors think that they have to take the money out. Many a times, the market has done well and you have some normal tempting spending coming your way. You just go and you get into some impulsive buying or spending, big ticket spending, and you end up redeeming your investment. Redemption has also become easy. You can do it online, you get back home, do it yourself. Then the third reason why, in an impulsive manner, people take their money out. If the market collapses, if the market goes down dramatically, people think that enough is enough, they have to take, they can't take losses anymore. And these are the wrong reasons to sell. The wrong reason, it is absolutely there is no reason why, because investment has gone up and that is why you should take your money out. Simply because, that is assuming that market necessarily go up to come down. And it does often happen once in a while in the short run. But typically the equity market, they do come down, but in the long run, they only go up. And let me just give you the story. What happened during the period 2003 to 2008. Market went up from 2800 point to 33,000 point, then 4,000 point, then 5,000 points, straight up to 20,000 points. So if anybody would have sold at any of these levels, then thinking that market go up to come down and they will be able to buy it cheaper once again, they never got an opportunity. The biggest Indian bull run was a completely unidirectional. For a few days or few weeks, there would have been some small correction, but not of any significant scale. So if you were waiting for the correction, if you wanted to take your money out because the market will go down again and you will invest, it happened as recently as 2020. The pandemic happened. Everybody thought that markets, as our life is coming to a standstill, the market will come to a standstill. And it did. The market did fall in 10 days time by 30%. That is in the month of March 2020. And everybody thought that, okay, this is on a free fall, such a big decline in such a brief period of time. Everybody thought that, okay, it is time to pack and go home. And many investors did. And that is what led to that big decline. And after that, the market started going up as we started reconciling that, okay, life will go on, things will get back, the vaccinations will be invented, and then life will be back to normal in some time frame, and many things will settle down with the abnormal, the abnormal thing that was the unusual thing. We started working from home, the digital thing happened, many things got restored, many things started happening differently, and over a period of time, and of course many things never came back to normal, but markets did recover substantially and never to go down further again. And that was the big opportunity loss. So the people who have this timing instinct, nobody knows anything to a point that we can't really delve, we can't peep into the future. But despite that, market generally tends to go up simply because, and any such thing should be looked upon as an opportunity or as a short-term opportunity, or at worst a medium-term opportunity. And timing it perfectly is very difficult. So anyway, give it up on that. Be methodical. Resist your temptation to take your money out. Taking your money out might look like very attractive at different points. The biggest problem of taking your money out and being right with it is that assuming you have invested 5,000 rupees every month and it has got accumulated into, over a long period of time, it has accumulated into something like 25 lakh rupees. And you think that the market is overheated and you take your money out. And after that, it turns out to be true. The market was overheated. It came down by 20%. The real problem is that it will become impossible for you to get in because you were right, and because now you will wait for this market to, because you were right, so you will think that, okay, it will go down further, and then market will recover once again by 10-15%, and then it will become really impossible for you to get in. Be methodical with your redemptions. Be methodical when you sell your investment. This is the reverse of, or the converse of point number 3, that be methodical with your purchases. Be methodical with your redemption. So it is exactly converse, and why you should be methodical about it. You should not be randomly redeeming your investment. You should not be selling your investment. And the very reason why you should not be randomly investing is the very reason why you should not be randomly redeeming your or selling your investment. So as I said, that do your SIP, be gradual about it. That is the right way of doing it. Likewise, selling your investment, be gradual about it. The converse of that is systematic withdrawal plan, SWP. This is the reverse of SIP. SIP is putting a constant amount of money into that investment. SWP is withdrawing a constant amount of money over a defined period of time of your choice. So you choose to take back 15,000 rupees a month for the next 18 months. And this should be goal oriented. And it is very important for you to be methodical about your redemptions when you sell your investment, because you can't depend on the market. Because markets could be very random, could be erratic. They could go up substantially, they could go down substantially, and you were trying to benefit by doing your SIP. You should try to de-risk yourself from the end state of the market, assuming that you need the money on a given day. And that is the time when the market, or a week before that, market collapses. So all your accumulation will go down, or it will be extremely disappointing. Being methodical with your redemption will ensure that it will not be a huge disappointment. However, it will be a disappointment.
That's all in today's episode. Thanks for watching. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.